By Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Chad, thanks a great deal for joining us. You say in some notes that historically earnings drive stocks, and that's something that investors should keep in mind during a volatile period and a period of bear markets like we're in right now.
Right, and that's the part of the issue. The markets in the short run are going to be quite volatile, and you can still continue to see some compression on broader indexes going into 2023. But one should not lose track of the longer-term picture about compounding. The financial markets, and particularly the equity markets, move higher to higher highs based off of economic activity and GDP growth over the long run, 10, 20, 30 years, which then drives earnings. And in the long run, we still believe the United States has around a 6 or 7% long-term forecasted return.
You've provided us some data as well. We've had these graphs prepared. They show us the S&P 500 running all the way from the late 1940s, I believe, to the present day, and also shows us the trend line as well. So there it is, the white line showing the S&P 500, the key U.S. equity index from the late 40s or so up until the present time, trending up to 3,800 points. The blue line is the S&P 500 trend line. It's a straight line, and it indicates the trend, and the trend is very much up from that over that long period of time.
Right. My colleague, Kevin Curran, wrote a research report that provided that information. It really gives you a bigger picture perspective on why one would invest in equities to fight the rate of inflation and to very well be aware that you are going to see market pullbacks that could be quite dramatic over a shorter intermediate period of time. And we're going through one right now. We still haven't had that earnings recession. So expect in 2023 to see that earnings recession. Typically, when that happens, you get a market pullback that can be between 10 and 20%. We would advise investors to look and buy into that, looking at higher quality companies that don't have a lot of debt on their balance sheet, that are very predictable, and have a higher return on invested capital. Those three attributes reduce the risk of a company going out of business, and you get more of a smoother, founded growth pattern for returns.
Okay, you've also got something on money supply here. That's key to inflation and the Fed's campaign to fight inflation. Here's a look at money supply growth from 1965 or so all the way to the present time. Explain this to our viewers.
Sure. So money supply, we believe, is the critical reason for inflation that you're seeing in the United States. And you could look at money supply from other countries, and they all exploded to the upside as a reaction to the COVID relief that was provided as a bridge. That created a diminution of purchasing power over the short, intermediate, and long term. Now you're seeing that money supply come in quite a bit and perhaps even be contracting at this point, which is deflationary. So we believe that that is actually a major headwind for inflation trends in the coming years, as well as a flag, a warning sign that earnings and economic growth should decelerate and potentially go negative.
And finally, let's take a look at the yield curve, often considered a key predictor of recessions. You've also got a long-term view of the yield curve. When the white line touches the baseline there, or moves below it, that is an indication of longer-term interest rates being lower than shorter-term interest rates. That's referred to as an inversion of the yield curve. And those blue bars that run vertically through this time period are periods of recession. And as viewers can see, those recessions are all very often preceded by an inversion of the yield curve.
Right. So as a canary in the coal mine, Washington Crossing Advisors looks at the 3-month yield in relationship to the 10-year. Typically, what we've noticed is that when you have an inversion, and I believe right now it's even greater than that chart that is presented, that you have a higher likelihood of a actual recession. Why is that? Well, lending then becomes somewhat more restrictive by big banks and other financial institutions, sapping the growth of credit overall, providing that economic headwind. Again, just another example of a decelerating U.S. economy, a decelerating global economy in the coming quarters.
Okay, so with all of that in the background, at this juncture, you like consumer staples and technology stocks, and you like three stocks in particular: Pepsi, Microsoft, and Tractor Supply Company, perhaps a lesser-known stock. Why don't you touch on all three of those?
So the thematic here is quality investing as opposed to low quality or value or growth. We're going up the quality spectrum, buying three companies that have a certain attribute. One, they can't have a lot of debt on their balance sheet. Two, they have to be very resilient, meaning they have to be able to earn and have a past history of earning money even in recessionary periods. And then three, higher return on invested capital. When we take a look at Pepsi, for example, we see all of those three attributes, including a rising dividend thematic. Pepsi needs to grow at roughly about a 3% to 4% organic growth rate to be a very good investment over the next 3, 5, and 7 years. And again, it's a rising dividend company. The second one that has a very, very defensible moat is Microsoft. Very little debt, a lot of cash on their balance sheet. We think it's better suited from other technology names in an economic slowdown based on the necessity of their products that they put out, that actual customers will have to buy them. And then the third one, Tractor Supply, is our newest addition to the rising dividend portfolio. $25 billion market cap, organic revenue growth roughly about 5 to 8%. We think that even in a recessionary period, this type of company could thrive quite a bit. So we have three buys in our portfolio that are rising dividend in their general nature.
Chad,